This is Nightly Business Report with Sue Herrera and Bill Griffin.
Taking a toll, rising interest rates continue to hit stocks, but now there's a new concern. Could rising costs take a bite out of corporate profits?
Rude awakening. Mortgage rates rise to a level not seen in 8 years. Why it could spell trouble for the winter housing market.
And gathering storm as Hurricane Michael bears down on Florida. Residents and retailers hunker down once again. All that and more tonight on Nightly Business Report for this Tuesday, October the 9th.
Good evening, everyone, and welcome. A choppy session for stocks today. The major indexes swung between gains and losses throughout the day as investors once again grapple with how exactly higher interest rates might affect stocks. But today wasn't just about interest rates. It's also about inflation and how rising costs could hit corporate America as earnings season approaches. So today, the Dow Jones Industrial Average fell 56 points to 26,430. The Nasdaq rose 2, and the S&P 500 was down 4.
But let's start with those interest rates. Yes, they've been rising, and expectations are that will continue. As you know, that's a big shift for the stock market that has been enjoying historically low interest rates for a very long time. But investors now need to know why rates are rising. So we asked Steve Leisman to explain.
Interest rates are rising, and the question Wall Street wants to know is if they're going up for the right reasons or the wrong ones. That is, are rates going up because growth is going up or just because of inflation without the growth? J.P. Morgan declaring in a research report, quote, rising U.S. bond yields are a symptom of U.S. strength and should not be feared. The trouble for stock investors is that until now they've been able to have their cake and pretty much eat it too. That is, better growth and higher earnings while interest rates stayed unusually low. In fact, the Treasury markets had almost ignored the Fed's increases in short-term rates. That's until now.
It's not just Fed policy. It's also just a generally strong consumer confidence that we see at this point of time. The economy has looked strong for years, and especially since Trump took presidency. And I think we're just in an exuberant time. People find these rate increases as normal given the economic conditions.
The list of what's pushing up rates is long. There's better growth and lower unemployment. Core inflation, that is excluding food and energy, is solidly now above 2%. The Fed is pushing up rates, and sometime next year, other central banks may also increase their rates. There are tariffs pushing up prices. There's also a growing deficit, which also usually means higher interest rates. Those higher rates could put a crimp in growth, hurting sectors like housing and autos, but they're not expected to derail it.
We're seeing the return to more normal term premia, the extra yield that people demand for holding long-term paper. So I think it's in this case, it's a relatively good sign. It means that there's confidence that the economy is coming back.
One modest upside could be that higher rates will help the Fed slow the economy to a more manageable growth rate. If so, the central bank could be done raising rates sooner rather than later, adding just another 1 percentage point from here. That's if rates are rising for the right reason, that is growth, and not the wrong one, which is inflation. For Nightly Business Report, I'm Steve Leisman.
And one industry paying very close attention to interest rates is the auto sector. As rates move higher, financing a car is becoming more expensive. That, along with higher sticker prices, is translating into monthly payments that are close to record levels. Phil LeBeau has more.
It is the part of buying a car that nearly everyone dreads, determining how much you'll pay every month. 4 out of 5 consumers finance their new vehicle with an auto loan. And as the Federal Reserve has gradually raised rates, it's forced lenders to do the same with auto loans. As a result, monthly payments and auto interest rates have steadily moved higher. 5 years ago, buyers paid an average of $457 a month on a loan with a rate under 4.5%. Since then, monthly payments and interest rates have steadily moved higher. Today, the average new vehicle payment is now well over $500 a month, and the average rate is close to 6%. Those higher costs have not slowed down demand, mainly because consumer sentiment remains near a record high, so millions are still looking to buy. In fact, sales this year are on pace to top 17 million vehicles. making this the best 4-year stretch of auto sales the U.S. has ever seen. And while you may see showrooms offering 0% deals, it is harder and harder to actually get one. Edmund says there is no interest rate on just 5% of all auto loans, the lowest level since 2005. If interest rates continue to move higher, there is a concern the monthly payments will rise to a point where auto buyers say it's too expensive. But so far, dealers have yet to see that happen. Phil LeBeau, Nightly Business Report, Chicago.
And today, the head of the Dallas Fed said he supports moving ahead gradually and patiently with interest rate increases. And even though he sees inflationary pressures building, Robert Kaplan also believes that dueling forces will keep prices from spiking sharply.
I don't believe inflation is going to run away from us. I think you're going to see, particularly with the tariffs and input costs, you're going to see it building. But I personally think that these more structural forces are not going away. If anything, they're intensifying. And I think they're going to have some muting effect on inflation.
And Mr. Kaplan also said he is starting to see companies try to raise prices for the first time in a long time to counter those rising input costs.
And the trade issue with China is a game changer for the global economy. So says the International Monetary Fund, which is cutting its outlook for world economic growth to 3.7%. The organization says that when the world's two top economies impose tariffs on each other, everyone feels it. The IMF expects growth in the U.S. to slow to 2.5% next year. Growth in China could drop to 6.2%.
Did you know that 85% of the toys sold in the U.S. are made in China? So it makes sense that industry executives are very concerned about the current tariff tiff, and that includes the CEO of Mattel.
We are watching this situation very closely, and there could be an impact on the industry. This is outside of our control, but our role is to design an organization that is flexible and adaptive and can respond to market changes and negative headwinds.
And he added that Mattel is also looking at different manufacturing options as a way to deal with the impact of trade tensions.
And investors will be listening for comments about China, trade, inflation, and interest rates when companies report their earnings and issue their outlooks for the rest of the year. Yesterday, as we reported, industrial company PPG said soft demand from China is turning into a big problem, as is significant rises in raw materials costs. The stock dropped 10% today, continuing the late slide that we told you about yesterday.
Well, the effects of the trade tensions are starting to be felt globally as well, not just in the U.S. Britain's biggest car maker today reported a nearly 50% drop in sales in China, saying that import duties and a trade war with the U.S. has hurt demand. And so Jaguar Land Rover said today it's going to close a UK-based plant for 2 weeks to align supply better with fluctuating demand.
And Procter Gamble said it received word from the U.S. government that it is now exempt from the 25% tariff on imported steel. P&G said the steel is used for its razor blades, a product that makes up the majority of P&G's grooming business. The decision is a relief for the company since P&G said it was unable to find enough high-quality steel for their razors here in the U.S.
All right, so should investors expect to hear more about China and rising costs as earnings season gets underway? Joining us tonight, Karen Cavanaugh is Senior Market Strategist at Voya Investments. Karen, thanks for joining us tonight.
Thank you for having me.
So the Chinese economy is slowing down. Prices are going up in part because of tariffs. What impact do you think that will all have on earnings? What are we going to hear from companies starting next week?
Well, we definitely are going to be listening to see what they say about China. But right now, we're still expecting overall plus 20% growth, a little bit less than the second quarter. But right now, it looks like earnings growth is going to be about 20% year over year.
But what about specific industries? I mean, we just talked about P&G and PP&G yesterday, talking about the fact that their input costs are going up and they can have a material effect. Will we see some sector-specific comments from companies?
Yes, I think we will, especially in the automotive sector, in some of the agricultural products, some of the industrials. Any of the companies that import or export a lot with China, we're going to see the effect, and we're going to see them talk about that in their earnings calls. Plus, we're also going to see a lot of companies just talk about the general uncertainty. And uncertainty is never really a good thing for earnings. But despite that, that's even with all those worries around, we're still going to see 20% growth year over year. And that's because the U.S. economy is continuing to do well.
Okay, but the comparing to last year is going to be difficult because we had a pretty good year at the end of last year as well. So the question for investors is, do they continue to stay with these companies, or do you think they will start to suffer if this tiff continues much longer?
Well, I think that it depends on the company. Some of the companies are more agile, they're more flexible, and they can change the way they manufacture their products or sell their products. But I think that a lot of it is, we've been talking about this for so long, a lot of it is already baked in. So I think that we're already anticipating a lot of the bad news. So there is a potential upside for a lot of these companies that have really been bracing for the worst. Could end up being a good situation.
What about the economy overall? I mean, we just talked about the fact that global growth may be cut because of some of these tariffs, but the U.S. economy has been chugging right along. Do you anticipate that continuing into the new year?
I do, and I don't think that the tax cuts were just a sugar high, because now we're seeing companies actually become more productive, and those productive companies are being rewarded with better stock prices, and that productivity is working its way through the system, and that's making the workers more productive. That's going to increase wages, and that's good for sustained economic growth. So I see good things for the U.S. economy coming up. I see that 2019 is looking to shape up to be a pretty good economic year.
All right, we'll see what happens. Karen Cavanaugh with Voya Investment Management. Again, thanks for joining us tonight.
Thank you.
And it is time to take a look at some of today's upgrades and downgrades. Walmart was upgraded to buy from hold at Deutsche Bank. The analyst cites the retailer's growing online grocery business and its investment in e-commerce. The price target is $113. The shares finished up 2% to $97.08. And also at Deutsche Bank, Kroger was downgraded to sell from hold. The analyst cites higher costs as Kroger expands its e-commerce program. The price target is $24. Kroger shares were off nearly 5% today to $27.92.
Milan was downgraded to equal weight from overweight at Morgan Stanley. The analyst there cited recent trends in the highly competitive generic drug market. Price target now $36. Shares of Milan ended the day down nearly 2% to $34.61. Whirlpool was downgraded to neutral from overweight at JP Morgan. The analyst says that moderate home price appreciation may actually result in softer repair and remodel demand. Price target $122. Whirlpool shares fell more than 5% today to $106.30.
Still ahead, why investing in dividend stocks is getting a little bit trickier. Optimism among U.S. small business owners remains near historic levels, despite edging a bit lower last month. The survey from the National Federation of Independent Business showed that optimism dipped when it came to employment and capital spending, and that's a bit of a reversal from August. The top issue raised by companies remains a lack of skilled labor.
Sears has added a restructuring expert to its board just days before the struggling retailer faces a more than $100 million debt payment. The appointment comes just as Sears chairman and controlling shareholder Edward Lampert urges the board to approve a rescue plan to try and avoid bankruptcy.
D.R. Horton issued preliminary quarterly results, and they were not pretty. The home builder said sales for the period came in below expectations, and it is forecasting sales and orders to disappoint for the year as well. The company will report its full results next month. Today, shares of D.R. Horton fell 3%. And the sector is now in a bear market. The home builder ETF is down more than 20% from its high of earlier this year, thanks to those rising rates.
Speaking of which, the average rate now on the 30-year fixed mortgage, that's now crossed the 5% threshold for the first time in about 8 years. And for those looking to buy their first home, it's entirely possible this may be the highest rate they have ever seen. So the question is, will this send a chill through the winter housing market? Diana Olek takes a look for us tonight.
Back in the early 80s, when another celebrity was in the White House, mortgage rates were 3 times what they are now, and people still bought and sold homes. But today's buyers, especially millennial buyers, have short memories, and high home prices have more of them on the margins.
There's always going to be a few buyers, a certain percentage of buyers that are on the edge of being able to qualify, and when rates go up as much as they have, then that can actually push them out of being able to qualify for a home. Because of the debt-to-income guidelines that are associated with loan qualifications. So yeah, it does take a toll.
The last time the average rate on the 30-year fixed crossed 5% was almost 8 years ago, and that was only briefly. It hasn't really been sustained over 5% for at least a decade. A year ago, it was just below 4%, and 2 years ago hit a low of just below 3.5%. So what does that mean to borrowers? For example, on a $300,000 loan, you're paying about $200 more per month than you would have a year ago. But it's not just the payment, it's qualifying for the loan and also feeling good about buying at that rate. Consumers and investors have felt very good for a while now, but Nobel Prize-winning economist Robert Shiller says that's not always a good thing.
The economy seems to be coasting upward. But this kind of complacency, this kind of confidence, I think, is volatile.
The only good news for this winter's buyers is that higher rates could mean sellers finally realize the sky is not the limit and cut the red-hot home prices we're still seeing today. For Nightly Business Report, I'm Diana Olek in Washington.
And to read more about the impact of mortgage rates at 5%, you can head to our website at nbr.com.
An activist investor takes a stake in Starbucks. That's where we begin tonight's market focus. Bill Ackman of Pershing Square Capital today revealed a new $900 million position in the coffee chain. Ackman says the stock could more than double over the next 3 years. And he added that the retailer is one of the best positioned if minimum wages rise. Starbucks says it looks forward to a productive dialogue with Mr. Ackman. Starbucks shares rose 2% to $57.71. And takeover talk is heating up over at Papa John's. There are reports tonight that the Trian Fund management is considering a bid for that beleaguered pizza chain. But according to the Wall Street Journal, there is also no guarantee that a deal will get done. Papa John's has been exploring a sale while it tries to recover from a messy battle with its founder and former chairman and CEO, John Schnatter. Shares of Papa John's jumped nearly 9% to $54.90. American Airlines says that fuel costs are rising and that it lost $55 million in revenue last month due to Hurricane Florence. Those fuel costs concerned investors who sent those shares down more than 6% to $33.55.
ExxonMobil is committing $1 million over the next 2 years to promote a tax on carbon emissions by corporations. According to the Wall Street Journal, this type of donation is rare among the oil majors. Exxon, though, sees a carbon tax as an alternative to the patchwork regulations out there right now. ExxonMobil shares rose a fraction to $86.51 today. And shares of Snap hit an all-time low today after a Wall Street analyst warned that the company, in his words, is quickly running out of money. According to Nathanson, the social media platform may be forced to raise capital as early as the middle of next year. And the analyst, in the meantime, is also predicting a slowdown in user growth. Snap shares finished down more than 6% today to $7 even. And Bloomberg is reporting that a malicious implant was discovered a couple of months ago on a server owned by telecom company Supermicro Computer. That report follows that Bloomberg Businessweek article of last week that said that Chinese manufacturers had secretly inserted spy chips on Supermicro motherboards. Supermicro is denying the claims in both of those articles now. Nonetheless, shares of Supermicro plunged by 15% today to $12.46.
Many investors look to dividend stocks for income, and some of the top-paying dividend stocks in the S&P 500 so far this year are names like CenturyLink, L Brands, Kimco Realty, and others. But as interest rates rise, should your dividend strategy change? Jeremy Zirin is the head of investment strategy at UBS Wealth Management Research. He joins us tonight. Jeremy, so I guess that is the question. You want to look for dividend stocks, but are there different types of dividend stocks that in a rising rate environment might be a better bet than others?
Certainly. if interest rates are rising because the economy is expanding and growth is picking up, that means that companies' earnings should be rising and that they should be able to fund the dividend. The problem for dividend investors is that when interest rates rise, that means that bonds create more competition for dividend-yielding stocks. So what you see when interest rates rise, typically you see higher dividend-yielding stocks in the market lag the overall market. But where you really see a difference is in the dividend growth stocks versus higher dividend-yielding stocks. So our view is that looking forward, the long end of the bond yield curve is probably already moved and seen the bulk of its increase. And that short-term rates certainly will increase with the Federal Reserve increasing interest rates. But dividend growth stocks should provide a greater ballast in the portfolio. They'll benefit from increasing their dividend, and they'll provide a bit of a hedge against future inflation because those companies are able to raise their dividends.
The list we showed there of the top 10 dividend-paying companies, the yield at the high end is at above 10% right now, but you see the 8%, the 6%, the 5%. Is there a level above which you won't go because it may present more risk than necessary? I mean, people may be tempted to go to the higher risk, higher yielding stocks because of higher interest rates, right?
Exactly, but I think the issue with that is that those stocks that have the highest dividend yield also have the highest negative sensitivity to rising rates. So what you see when interest rates rise, you see the highest yielding stocks underperform the market by the greatest amount because they benefited the most from the low interest rate environment.
So what's the sweet spot? What's the sweet spot then for yields? If you can say that broadly speaking here, right?
Broadly speaking, we tend to think about looking for stocks that consistently grow their dividend and have a dividend yield anywhere from 2 to 3%, right? So you sacrifice some of the current yield because you'll make it up in those companies compounding their dividend growth over multiple years.
All right, on that note, Jeremy, thank you very much. Jeremy Zirin with UBS Wealth Management.
And coming up, preparing for another hurricane.
I'm Courtney Reagan in Panama City, Florida, where retailers like Home Depot are full of residents still stocking up before Hurricane Michael. I'll take inventory coming up on Nightly Business Report.
And here's a look at what to watch for tomorrow. The Producer Price Index, a key gauge of inflation, will be released. And with the focus on interest rates, it could move both the bond and the stock market. Investors will also be paying close attention to comments from a number of Federal Reserve officials. And Hurricane Michael is on track to make landfall in the Florida Panhandle. That's what to watch for on Wednesday.
Always love that segment. And as Hurricane Michael approaches the Florida coast, energy producers are temporarily shuttering their operations in the Gulf of Mexico, affecting both oil and natural gas production. According to one estimate, about 40% of Gulf Coast daily oil production has already been taken offline. ExxonMobil, Chevron, and Anadarko are some of the operators that have evacuated their rigs at this point. Both domestic crude and natural gas prices settled higher in the futures markets today.
And as that storm makes its way to land, the retailers down there are preparing for the worst. And they're working hard to get supplies to where they need to be. Courtney Reagan is in Panama City, Florida for us.
Retailers are spending critical hours before Hurricane Michael hits the Florida Panhandle, plotting logistics to get truckloads of supplies to stores. This storm is expected to produce high winds, up to a 12-foot storm surge, and up to a foot of rain. Supplies like plywood, generators, gas cans, tarps, chainsaws, batteries, and more are critical. Even as mandatory evacuation orders went into effect, many residents are staying through the storm, lining up for supplies starting this morning.
I need a new saw blade and some batteries and making an extension cord for the generator.
I'm shopping for sand today to put in front of the door.
We have so much water, no generator.
Home Depot has deployed more than 300 shipments to its 30 stores in the affected areas.
We ran out of generators yesterday, so we called Atlanta. Atlanta sent us 3 or 4 truckloads. We went through almost 200 today.
Lowe's has already sent out 200 trucks full of supplies to the 50 stores in Hurricane Michael's path. Not all the trucks have gotten to the stores yet. At least for now, the drivers should be able to be on the roads and deliver the goods.
Each storm is different. Every storm that's come in is different. We've got very limited time as far as this storm goes, so we're going to keep the bridges open as long as possible.
Jack and Mackenzie Bennett have spent hundreds of dollars preparing. They have to stay because Jack works in law enforcement.
Stocking up for the storm, preparing. We got a bunch of plywood to go board up the house.
Hurricane Michael formed quickly and is only intensifying, catching some residents off guard and behind in their planning. Retailers, too, are closing earlier than anticipated. This Home Depot will close at 8 p.m. tonight and not reopen until 8 a.m. Thursday morning. Nearby Lowe's closed at 1:30 this afternoon.
I've been through about 3 or 4, but this is the most powerful one that's been hit. We're in direct contact with.
Many critical supplies are still available, but residents are running out of time. For Nightly Business Report, I'm Courtney Reagan in Panama City, Florida.
Finally tonight, the iconic toy retailer FAO Schwarz is officially returning to New York City. The company says it's planning to open a flagship store in Manhattan's Rockefeller Center next month, more than 3 years after it closed its longtime Fifth Avenue location. Back in August, remember, we reported that such a move was in the works. And also, FAO Schwarz also says it plans to grow its presence in international markets, including Canada, China, and Europe.
Cannot wait. All right, before we go, here's a look at the day on Wall Street, she tried to say. The Dow fell 56 points, the NASDAQ rose 2, and the S&P 500 was down 4. Got me all tongue-tied thinking about FAO
I can't wait to see
Schwarz.
those tall nutcrackers guarding the front door.
That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.